Kevin, do you share the enthusiasm around what's coming from Washington?
Well, yeah, it is a very important thing, both of these things, because there have been three big worries that have really hurt sentiment and growth, and it's been trade, it's been the concern about the budget here, and then, of course, Brexit and what's going on in Europe. So anything that breaks in a positive direction there is helpful, both in terms of enlivening sentiment, but potentially for helping eventually to get rid of a lot of these clouds that is hanging over global growth.
Treasury yields higher, the dollar's higher. Mike, how do the cross currents play in here, especially because we're knee deep in the middle of earnings as well?
Yeah, I think the Treasury yields being higher is a key right now, right? You didn't necessarily want a situation where the bond market was really continuing to price in a struggle for the economy this year and have the stock market just rebounding in the absence of any real evidence of that. So I do think the combination of the fact that growth did not obviously seem to really decelerate, we're getting further confirmation of that right now, even though the first quarter numbers are going to be given a little bit of an allowance because of the shutdown distortion effects. So I think it's mostly extreme negative positioning and sentiment in December was the setup. We're continuing to kind of burn off a lot of that skepticism with this reality that, you know, the economy didn't change that much in December, even though the market was down a lot. Beyond that, I do think we might get to a point where we've talked about the subtraction of all fears. That's what we've had this year. And after that moment, we have to decide what's the catalyst, because earnings estimates are still trailing down for the first half. So if you get a China deal at the moment where people think that we can trough earnings forecast for the first half, that would be the ideal setup, but it's hard to know if that's going to happen.
Kevin, we were told by some that 2750 would be some sort of difficult hill, and obviously we're here now. I wonder at what point does sentiment look stretched, because we're not getting those numbers yet.
I'm not a technician, but we have gone from a point where some technicians would have said we were oversold back in December, that very compressed level with a lot of negative sentiment, to now something that in just 6 weeks feels very different. But I think that what you really have to do is take a much bigger step back and look at the bond market. In the last year, you've seen a 100 basis point or so flattening of the yield curve. You've seen a 100 basis point or so expansion of credit spreads. And overall, there's been just slower economic growth. We got data today out of Europe about industrial production there that looks very sloppy, and similar kind of things out of China. So we're very happy to see some positive things on these near-term worries, but ultimately we need to see growth accelerate and pick up from here. We're just not there yet in terms of seeing it in the data.
Mike, given the current environment that Kevin just laid out on growth and rates and everything, where would you look for leadership in this market?
It's interesting because you saw the stuff that was the most blasted out, right, and lead the way off the bottom. Real deep value stuff, and also very high beta stocks that were trounced and now have come back a lot. So that's been, I think, a decent source of the initial bout of leadership. Semiconductors coming back a lot, small cap stocks leading. But at this point, I think you're at a moment where if the story is earnings are okay, valuations in general aren't yet too stretched the way they were early last year, then it would be more holistic. I think you would want to see broader participation. In other words, wherever the earnings are holding up, that's the stocks that should hold up. The growth names are working again, right? The big cap growth names. It's not as if you've seen this massive pivot to other types of stocks that are pure value.
But interestingly, industrials are the best performers so far.
And that would be a China trade for now. I mean, look, you could easily envision a moment where you get to 2,800 in the S&P, which is an area that's halted the market at a stop in the fall a couple of times, and say, well, valuation is no longer cheap. Is the Fed back in the game? Because all of a sudden we have a 6-month look ahead, and that's in the zone where they might be hiking rates. So it could complicate the story a little bit. But 2750 to Carl's point is not necessarily putting up much.
I wonder what you make of credit demand. NFIB obviously makes some people wonder about CapEx and the manufacturing specifically. New York Fed had a report on credit inquiries from households at the lowest since the data set began. I mean, is loan growth, is it a lost cause?
I don't know if it's a lost cause. I do think that first of all, you definitely had a big sentiment gut check in the last few months, which is going to cool off people's appetite for debt. But, I don't think you've changed the fact that the credit cycle is mature, right? I mean, you still have had the companies that could borrow and refinance have done it. Small business, I mean, it's funny, that NFIB survey always says credit's too tight, right? Because these are like mom and pop, literal mom and pop shops. So it's hard to know from that one, but I do think that a mature credit cycle hasn't really changed, even though conditions are not yet as stressed as they had been.
Did you guys see this from the New York Fed, the auto loan problems?
Yeah.
I mean, Kevin, auto loan delinquencies surging past Great Recession rates, starting to really pile up. Is that some sort of indication about consumer credit and where the economy is heading?
Yeah, it does look like consumer credit is slowing down. You're seeing it in mortgage demand and activity in the housing market. When you look at autos, I think you've had a very robust period of time with record sales and record prices, too. If you look at the prices of things like SUVs in America, they're extremely high. So those balances have piled up. And like every good credit cycle in the past, there's usually a period of indigestion that follows. So we'd expect to see some of that happen over the next couple of years. Maybe one of the positives, though, is that the Fed has backed away. So that's another catalyst, potentially, that the Fed has really moved to this patient posture, which has allowed markets to think about maybe a flattening out of rate expectations. And that could help the credit cycle, too.
The auto loan delinquency story is both something that's noteworthy, but also noteworthy how much it's being noted. Right. In other words, people are jumping on this idea that, uh-oh, here we go again. And I think there's a massive difference between autos and everything
pushback
else.
I get from some people is that it's easier to repossess a car. It's not a life-changing event.
Nobody ever financed a car thinking it was going to go up in value and they were going to flip it to somebody. Yeah. And that's different from houses 10 years ago, 20 years ago.
Not to mention the securitization of all the...
We're
not talking about massive securitization being spread around the world and leveraged 20 times.
Right. House of Cars.